heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Ed Ludlow here in San Francisco. Caroline Hyde is off today. This is Bloomberg Technology. Let's get after it. Coming up, Intel surging as its long-awaited comeback is underway. We're going to break down the company's earnings with the CEO, Pat Gelsinger. Plus, we're going to have an exclusive interview with the CEO of buy now, pay later company Affirm, his outlook on fintech and the payments space. And we'll push ahead to what is going to be another crazy week in tech earnings with Amazon, Apple and Qualcomm all reporting next week. First, let's going to check on markets. Earnings has been a key theme this week for the technology sector. Let's get over to Bloomberg's Abigail Doolittle with the numbers. Abby.
Well, Ed, it's certainly been a big week for earnings this week, and it will, to your point, be one next week. So far, investors liking it. The fear around this earnings quarter and ripples, the idea that perhaps the bar was going to be too high. Well, it's simply not happening yet, at least with some of the tech movers. But overall, you can see on the day we have a very nice rally at this point. The major indexes all up more than 1%. The tech-heavy NASDAQ, tech-heavy index is up more than 2%. And we have the New York FANG index up even more, up about 2.3%. So really pretty impressive performance there. Now, if we take a look on the week, the standout sector for the S&P 500, not surprisingly, the communication services sector, that's the one that has your Meta and your Alphabet. And what did they do, Ed? Well, of course, they put up great quarters and outlooks driven by this recovery in ad sales or firmer ad sales. So if we take a look at Alphabet on the week, we're going to see pretty solid gains. The same deal for, well, actually, at this point, we have Microsoft down on the week. That was one of the exceptions to the quarters that we had this week, Ed. And that had to do with the fact that revenue growth stayed in the high single-digit area, and the cloud missed a little bit. So that sets up Apple for next week, because Apple's revenue for the quarter that just was, it's expected to decline 2.5%. Is that a low bar, or is that going to present some kind of issue going ahead? We don't know. But what all of these stocks are facing is that NASDAQ 100 on the year up more than 40%. Price to perfection, too far, too fast. The sugar rush that we saw yesterday, it faded a little bit. Well, of course, it's back today. At some point, this probably will give way, but we're seeing no signs of that certainly today. So it's all eyes on next week and those big earnings reports.
All right, Bloomberg's Abigail Doolittle out in New York. Happy Friday to you. We're going to stick with tech out this way out west. Earnings next week include Apple, Amazon, and Qualcomm. It's been an interesting dynamic where the market is so hyped up about AI, but if you look at the trading, I think we're kind of focused on some of the core businesses of these names. Will that be the story next week? Let's ask Jonathan Curtis, Director of Portfolio Management for Franklin Equity, overseeing $9.5 billion in assets under management. What do you make of that, Jonathan? Investors love AI, but this week it seems like they traded on the fundamentals, the core business.
Yeah, well, so certainly there's a lot of excitement, and appropriately so, around AI. But we are in the stage of this opportunity that we like to call the experimentation phase. Companies are learning about how to use generative AI. They've been reorienting their product roadmaps to take advantage of AI. They're starting to figure out what their customers are going to be willing to pay for some of these capabilities. But we're not really in the scale it stage. We think that's going to come here in the next 2 to 3, maybe 4 quarters. And the biggest, most important thing to be watching there is what platforms like Microsoft or Adobe or other companies that have many hundreds of millions of users can do when they start putting these AI capabilities in their products, where hundreds of millions of knowledge workers and media creators operate every single day. We're quite excited about what that means and how that will put pressure on the underlying infrastructure and semiconductor layer and keep the growth going for a lot of these companies.
So we do this every quarter now, track the number of times AI as a phrase or word is mentioned on an earnings call. Do you go through the transcript and say, okay, AI number 1, AI number 2? I mean, seriously, how much does that impact your investment
we did
thesis?
do that, yeah. So this past earnings cycle, not this current one because we're not completely through it, we did go through and count how many references there were to artificial intelligence. And then we compared it to references to things like mobile back around the launch of the iPhone, because we wanted to get a sense for how quickly this was dispersing through the economy relative to other big cycles that we've seen in the past. And
but Jonathan, why? Why, Jonathan? They're just words. What do they tell you about?
No, they're not just words. They're intentionality. And what's important about that intentionality is it tells you how much the other sectors outside of the economy, outside of tech, are gearing up and getting curious about this opportunity, and ultimately what the big spending is going to come. And what's fascinating about the analysis we did 90 days ago was that we saw much more dispersion for artificial intelligence than we did for mobile back at the start of the iPhone cycle, the iPhone opportunity. So that gives us a little bit of confidence that this could be even bigger than other big cycles we've seen in the past, like mobile.
Jonathan, I want to talk about the semiconductor names. We're going to be speaking to Pat Gelsinger in about 5 minutes' time, the CEO of Intel. You do not hold Intel, but I believe you do hold NVIDIA and AMD. Explain that thesis to me and why they are the winners in AI.
Yeah, so certainly Intel is an amazing company. There are funds within Franklin that own Intel. They are in the midst of a challenging transformation. And they're a little too PC-centric for our growth needs. And they're in a heavy investment stage right now. So we're watching Intel closely. We like NVIDIA because they're highly aligned with the AI opportunity and have an incredible moat there. We like AMD because they are a share gainer in the server space at the expense of Intel. We also like TSMC, which is one of Intel's emerging competitors in the fabrication of chips. And AMD and TSMC and NVIDIA and TSMC together are really helping set the next stage of growth in the semiconductor space. And Intel is just playing catch-up, quite frankly, and is a little too PC-centric for our interests.
PC-centric. The other area we want to talk about is cloud. And we started this conversation, Jonathan, by pointing out that a lot of the trading this week was done on core legacy businesses. Abigail mentioned Microsoft, where investors looked at the performance of the cloud business from a top-line growth perspective and weren't as happy. What do you see there?
Well, encouragingly, we are starting to see some of that deceleration that we've been seeing in cloud in this post-COVID era starting to calm down a bit. And in fact, the deceleration that Microsoft witnessed in its cloud business slowed a bit. And encouragingly, we're starting to see the real positive impacts from the AI experimentation phase that we're in right now, impacting the cloud operators like Microsoft, like Google. So we think that we are getting through the optimization phase post-COVID. We are getting into easier comps there. And now we're starting to see AI become a material contributor to these cloud businesses. So we think in our broader digital transformation thesis, AI is still misunderstood by investors. They don't understand how profound the impacts of this is going to be. And then the cloud opportunity is going to be a big participant along with AI, but also as digital transformation continues. And we're starting to see that stabilization. So we're quite encouraged by both what we're seeing in AI and in cloud.
All right, Jonathan Curtis, Franklin Equity Group, Director of Portfolio Strategy. Just such a wide-ranging conversation. And as we discussed, the next big conversation is going to be about the chip sector. Thank you very much. Coming up, stay tuned, because we will sit down with the CEO of Intel, Pat Gelsinger. The market really liked what it had to hear about the quarter just gone and the outlook for the current quarter. But there are long-term questions here about Intel returning to a position of leadership when it comes to the cutting edge of chip manufacturing, chip-making technology, and also, what is the future of this company in the field of AI? Pat Gelsinger, Intel CEO, coming up next here in San Francisco. This is Bloomberg Technology. I want to welcome our global Bloomberg TV and radio audiences. Intel shares are jumping, with investors buying into signs that the chipmaker's long-awaited comeback is underway. Intel is forecasting sales in the current quarter of $13.9 billion, ahead of expectations. The company also notched a surprise profit of 13 cents a share in the quarter just gone, as a slump in demand for personal computers appears to be coming to an end. It's not all good news. Server demand isn't recovering as quickly. The company's still a little bit far from its heyday, where margins were at 60%, sales were nearer to $20 billion. Even so. Joining us now, Intel's CEO, Pat Gelsinger. You know, Pat, this is the second consecutive quarter where investors have cheered the earnings results. Shares are up. And I think before 2023, 10 out of the 11 earnings prints that you had, shares fell. Is this job done for you in the turnaround at Intel?
Well, Ed, we have a long way to go yet. But boy, having two good beat and raise quarters in a row, is super positive and really, I think, indicative of that turning point for the company. But we still have a lot of work to do yet. As we said, our client business is now, healthy footing. We've returned market share to where it traditionally was, a strong roadmap. The market's recovering, inventory levels are good. Data center, we still have work to do, but boy, 2 quarters in a row where we did a bit better than we expected. But we still have challenges in AI. And many of our really good products are only coming to market over the next year. Networking, still a lot of inventory to work through. And our foundry business is still just a seedling, just starting to show some green shoots. So I'll say, boy, far from finished, but it is nice bouncing off the bottom a bit and feeling that momentum in the market response.
Pat, why do you have the confidence to kind of call the end of the PC slump? And also at the same time state that the server recovery is delayed to the end of the year?
Yeah, in the PC side, inventory levels are now healthy, right? Everything that we've seen and a lot of the, issues that we worked through Q4, Q1, and Q2 were over inventory levels by the OEMs and the channel. And now everything is healthy. Our roadmap is very good. We've gained share multiple times in a row. I think we're now at 5 out of 6 quarters where we've gained market share. So I just say in the PC business, healthy. Our position is good. And we're looking forward to the AI PC. And with our launch of our next generation product, Meteor Lake, later this year, we believe that ushers in the AI PC generation. And I've compared that to like Centrino and Wi-Fi, 2 decades ago, a major new use case for why the PC is the best platform. So we're quite excited about that. On the data center side, we still saw that, the inventory levels still persist. China was weaker than expected. Their recovery is going slower. And, cyclically, we see the shift toward AI, these big training machines. Every cloud vendor is shifting their dollars to more focus on that. So those 3 things are leading to a bit longer recovery cycle on the data center. But like I said, we performed a bit better than we thought on the data center in Q1 and Q2. So we're feeling like our momentum and execution is rebuilding despite some of those headwinds that still persist in that area.
For our global TV and radio audience here at Bloomberg, we're speaking to Pat Gelsinger, the Intel CEO. Pat, you're forecasting gross margin of 43% in the current period. But it's a long way from that 60% gross margin level. Wall Street used to look at Intel and say, 60%. They would cheer you as a leader in that space. Can you just explain to our global audience the timeline and path to getting back to profit at that level?
Yeah, and we're working our way back in margins, and obviously a nice beat in Q2 on margins, and we forecast Q3 a bit better and Q4 a bit better. And part of it is the cyclicality of the semiconductor industry is brutal on margins. And when we, had an oversupply situation, inventory, that just depresses margins because, the factories cost the same whether they're full or whether they're empty. So you end up with these charges that burden the price points and depress margins. We also realize that our own product execution has weakened our product position, which doesn't have ASPs as strong as well. So that's another factor. And the last factor here is, the plan that my CFO, Dave, and I have laid out is an expensive plan. We are making aggressive investments to build the capacity to get back to leadership. And thus, we're moving through nodes very rapidly. We said 5 nodes in 4 years. So that causes us to have a lot of undepreciated capacity that we're working through quite aggressively. Also building up a bit more capacity for our foundry initiatives. So all of those factors depressed margins to historically low levels in the first part of the year. And we're just seeing ourselves now working to build back to margin levels. But we're still very confident that as we build our foundry business, get back to leadership in process and products, that those kind of margins, that's exactly what Dave and I aspire to the future. And we feel like Q2 was a good marker, that yes, we're building momentum to get back there.
Thank you for joining us here on Bloomberg Television and Radio Worldwide. We're joined by Pat Gelsinger, Intel's CEO. You described the foundry business as a seedling, but every time you and I have spoken, you've hinted that there is a big customer waiting in the wings to give life to that business. What can you tell us about that, Pat?
Yeah, and we're having good momentum. And as I said on the earnings call yesterday, we have 2 big customers in particular that we made very good progress over the last quarter for our foundry business. We did have one, I'll say, confirmatory, not as big a customer, but the Ericsson announcement, their commitment to 18A and our next generation work, with them that we announced this quarter. So I'll say overall, we're seeing good momentum and a really strong pipeline of customers, and we hope to make meaningful announcements later this year on that. We also pointed out on our earnings call that now we're seeing a lot of interest in our packaging technology. So it isn't just wafer manufacturing, it's also package assembly and test. And Intel has long-term been a leader in packaging technologies. And because of key areas like high-performance computing and AI, there's tremendous interest in these advanced packaging technologies. And we're finding a lot of customer interest in that incremental area of the foundry business as well. So overall, and the numbers were good for us in Q2 for foundry, great pipeline of activities, great progress on a couple of these most major opportunities. So I'm feeling good, like we're starting to really see that momentum build in this new business area for Intel, our Intel Foundry Services.
If we think about what a potential customer might be, at the scale of Apple or Google or Nvidia, what is it that they want from you? What is it do you think that you can provide them?
Yeah, when I view it, we have to go through 4 stages. One is, are my transistors good? Can they build good products using Intel? Second is, do I have the design tools, the Cadence and Synopsys EDAs and the IP libraries? Have we gotten all of those basics done so that they can design on us? Then third, do we have good terms and conditions? Are they better off coming to me versus, TSMC or Samsung as an alternative? And then finally, are we customer oriented? Can they really have the support? Because my factory becomes their factory. So we have to work through all 4 of those stages before they're ready to commit major businesses to us. And that's why it takes a while. They got to do designs and tests and pilots and, work through the financials. And, this isn't a mature business area for us. But I'll just say we're making great progress. And in particular, the 2 most significant opportunities, it was a really good quarter. And I'm feeling very optimistic that, yes, we'll bring them across the line and start to really accomplish what we've laid out, with our, reshoring and building the Western foundry. We also had great success with both the EU and the U.S. CHIPS Act this last quarter, which are affirming the strong support, of the Western governments on this strategy. It's the right strategy at the right time. We're making good progress.
A big part of your smart capital approach. We have to talk about AI. You see a world in which the PC plays a role for localized running of LLMs. But what are the use cases that you see, Pat? The applications where a PC with AI-specific chips is relevant?
Yeah, and, to some degree, they're numerous, Ed. Let's just give one example. In the future, my word processor, I'm going to hit a button and say, give me a legal brief that describes this, and it's going to get locally generated. My video conferencing, my Teams or Zooms, I'm going to say, give me, real-time translation across multiple languages, for this meeting. and I'm going to have that in real time on my PC. My games, for my, all of that is going to become synthetically generated worlds locally on my PC in real time. So we see it across creator, across productivity. And as I've said, this is sort of like a Wi-Fi moment, for the PC of the future, and that begins with our Meteor Lake launch in the second half of this year.
Pat, quickly, a $1 billion pipeline for AI products through 2024. Just give me a sense of the pace at which that pipeline is growing now.
Yeah, we had a super exciting quarter. As I said, we 6x'd that pipeline in Q2, so we saw a huge uptick on that. And I've deployed a lot more sales resources, software resources, to jump on those opportunities worldwide. When we have our Gaudi 2 chip that is, now in volume, we've just seen the first wafers on the next generation Gaudi 3, which will be our 2024, product, and then we have our 25 and 26 products underway. So, we're seeing a lot of momentum there, and the world is looking for a great alternative, an open alternative, a more cost-effective alternative, and Intel is a trusted supplier. We think this is a great, area for us to put a lot of energy into, and we're seeing the response from the marketplace now.
Intel CEO Pat Gelsinger, we appreciate your time here on Bloomberg TV and radio. Thank you.
Thank you so much. Always a pleasure, Ed.
Coming up, a chip equipment maker is showing signs of relief for the market. What one company's strong earnings could mean for the future of the industry. Fast start to this Friday. This is Bloomberg Technology. Time for talking tech. First up, KLA reported strong earnings for the current period. It signals that the chip industry may be nearing a recovery. Shares increased around 4.5% in the session, but it's unclear how long this upswing will last. Of course, it's a sign that chip makers are ready to spend on new equipment. Plus, a burning ship near the Netherlands has almost 500 electric cars on board. The cause of the blaze is still unknown, but the Coast Guard has denied reports that the fire broke out in the section of the carrier where the electric cars were stored. And finally, China has asked its largest tech companies to provide case studies of their most successful startup investments. The ask is a sign authorities are ready to grant them broader leeway after a crackdown that brought them to a virtual halt 2 years ago. All right, coming up, Threads, the Twitter-like app, might help bring the center of internet culture back to Meta. We'll take a look at the new app and its potential impact. This is Bloomberg Technology. Welcome back to Bloomberg Technology. Ed Ludlow here in San Francisco. A quick check on the markets. NASDAQ 100 up 2%. Strong end to the week. It's an interesting picture because a lot of tech shares are trading on some strong economic data. We had that surprisingly strong GDP print 24 hours ago, some measure of inflation, show inflation easing. And at the same time, we're all kind of hyped up about AI. But you look at the earnings week we've just had, and there's a big focus on a lot of these tech names trading on their fundamentals. Their core legacy businesses have done well. We will get into that in just a moment. In terms of single names we're watching tied to those earnings stories, Mr. Director is showing me Intel up 6%. We just had the CEO on. It was interesting, very confident in the recovery on the PC market. More work to do in data center and server. Lots of optimism about what AI will bring Intel. That stock higher. Ford off 4%. The losses from EVs will widen to $4.5 billion this year from a previously forecast $3 billion, and they will not achieve production of 600,000 EV units until next year, a year later than previously planned. And then Meta, so much momentum in this name, up 4%. It's kind of the forecast for the current period. $34.5 billion US dollars, strength in ads, confidence in AI, and then the successful launch of Threads. All right, let's keep it going. This week, we've mentioned the idea of everything apps, not only for X, the company formerly known as Twitter, but that conversation now going to TikTok as well. Just 24 hours ago, we spoke to Meta CFO Susan Li about the concept of everything apps and if Meta would consider itself heading in that direction. Here's what she had to say.
We're really invested in the opportunities that we have ahead of us across our family of apps right now, including Threads, which is the newest standalone app in our portfolio. And then there's just a lot that we can do to make the experiences across our family of apps richer and more engaging with the investments that we've made already in AI, and especially recommending content that you don't already follow. And we know that that's brought richer content experiences to people, is growing engagement across the apps. And we'll release we'll be releasing features over the course of the next years, but we're really excited about what we think that this is going to bring to bear for the consumer experience and, of course, also eventually for businesses to connect with consumers across the family of apps, too.
The Everything app. Let's break it down with Bloomberg's Alex Barinka, who covers the social platforms for us, and Rachel Tipograph, CEO and founder of MicMac, a global e-commerce enablement and analytics platform for multi-channel brands. First of all, Rachel, give me your definition of an Everything app.
An Everything app is a place where I'm going to spend the majority of my time to connect with my friends and family, be inspired, potentially do work, start a business, and transact.
So the news peg this week is X, the Everything app. It's officially happened. Twitter logo's gone, the Bluebird's gone, we have an X. But TikTok and Meta are still part of this conversation. Do you realistically see a world in which we see all three move towards an Everything app?
I think for Everything apps to work, we have to let go of the notion of walled gardens. Because to be everything, you need to integrate with the infrastructure of society. So if you want to drive commerce, you need to integrate with the biggest players in commerce: Amazon, Target, Walmart, payments like PayPal. If you want to integrate into work, you got to integrate into Salesforce and Slack and Oracle and SAP. The approach that the walled garden apps have taken is, hey, we want to do everything ourselves. That typically doesn't work out. So for Everything apps to come to life, there really needs to be a partner ecosystem that allows them to flourish in everyday life.
So I want to go back to the Meta part of this equation. Alex Barinka, you've written a story published on Bloomberg this morning. Meta has a rare opportunity to seize momentum with Threads. And I know you were watching the interview with Susan Li really closely. They're playing down the sort of near-term monetization of Threads. But is that the app that represents an opportunity for Meta to broaden itself out a bit?
And the reason I made that argument is because it's not just Twitter, or the app formerly known as Twitter, X. It's not just X that is kind of the biggest competition here for Meta, even if, as CFO Susan Li says, the Everything app isn't their kind of current focus. It's actually TikTok. Meta used to be kind of the kingmaker of internet culture. Instagram used to really rule the zeitgeist, and things that happened online happened there first. Right now, TikTok really has that position. And that's the argument I kind of laid out, Ed, in that piece, is Meta has a rare opportunity here, not to kill Twitter, but to actually bring kind of the center of internet culture back to Meta, because TikTok, while that is the place right now, TikTok's a video platform. Making videos is a lot harder than posting text online. So there could be this moment of opportunity. And Ed, when you and Caroline chatted to Susan Li yesterday, I was really struck when you asked her about kind of how you bring that zeitgeist back. She went straight to talking about product updates and changes to features, which is a little bit different than I know that TikTok thinks of itself. They talk about culture and bringing creators and music and fashion, and it's a little bit of a different flavor, but I think it's an important distinction as they continue to figure out what Threads how Threads fits into the Meta universe.
I like the historic dynamic, which is it's what people say, right? When something's trending on TikTok, your parent might see it on Reels or Instagram 6 weeks later. So with that in mind, Rachel, Alex tried to outline Meta's position, which is that they want to seize the cultural moment. Do you see that happening, or do you think TikTok leads in that respect?
So first, to debunk the myth, there are plenty of Gen X and boomers on TikTok. Nearly 50% of their users are not millennials and not Gen Z. So culture is happening there, but culture is now multi-generational. In terms of TikTok, yes, it is taking over search, which I think is a key indicator that culture is moving there. When it comes to Meta, there is a huge difference. Meta is an identity service. And because it's an identity service, it has an enormous amount of data to build a really, really robust advertising business on top of and move people down the path to purchase. TikTok has stayed more upper funnel, has focused on consumer engagement. They do a great job of that. And now they are trying to figure out, hey, can we actually steal market share from Meta by monetizing the data that we have in the platform? How they both use the data and how they've been building advertising businesses and commerce businesses on top of each other have differed because of the nature of the apps. But Meta being a center for culture, they have yet to demonstrate that they have the ability to do that again.
All right, our thanks to Rachel Tipograph and our own Alex Barinka. We probably could do a full hour on the media, social media landscape right now. We will have both of you back. Thank you very much. Coming up here on Bloomberg Technology, buy now, pay later service Affirm expanding its partnerships with travel and luxury retail brands. We're going to have that exclusive conversation coming up next. Max Levchin, Affirm CEO. This is Bloomberg Technology. Affirm, the popular buy now, pay later service, has gained traction in recent years as inflationary pressures weigh on consumer purchasing power. With more than 16 million active customers and more than 245,000 merchants, the company is a marker for tracking consumer trends across various sectors. Now it's expanding its reach in the travel space by partnering with airline Cathay Pacific. Very happy to welcome Max Levchin to the show, CEO of Affirm, and my good friend, Bloomberg's Shonali Basak.
Thank you, Ed, and thank you, Max, for joining us. When you took a look at this deal that you just cut with Cathay Pacific, this idea that more airlines, more travel is drawing buy now, pay later options, you know, it's very expensive to travel right now. How much kind of heat is there in the consumer wallet to be traveling with these kinds of prices, given kind of strains on their wallet right now?
I think we're still recovering from COVID, and the need to get out of the house to see the world is intense, and prices are absolutely high. We are seeing very expensive travel, and yet we're almost at the peak of 2019, right before the pandemic. And so part of the reason we're seeing so much success, so much pickup in the travel industry is the airlines cannot do enough to bring all these people a chance to travel, but it is expensive. And so being able to afford it, and with Affirm, without late fees, without gimmicks, without tricks, is a really powerful sales pitch. And so we're excited to partner.
I have about the airlines as well, because if you think about it, the credit card companies just reported earnings. They're extending loans like crazy. The consumer looks a little stretched when you look at how much debt they've taken out. There's a question about whether they'll hit a cliff at the end of this year. So how much can they really buy now, pay later, even more, to fund things that they want to do? Go out and buy luxury goods and to take an airplane to Europe.
I think fundamentally consumers will borrow to meet their goals. And my job is to provide a viable, transparent, and fundamentally better alternative than credit cards. If you see the growth of buy now, pay later, you can see that we are making a real dent in taking over more and more of the consumer spend. We are absolutely not adding to it in terms of incremental debt that is unsustainable as Affirm. Other players may do other things, but our fundamental design criteria is if we don't believe you can pay us back, we will not lend you money. That is what's enshrined in our design notion of no late fees, no gimmicks, no tricks. We will not benefit if you cannot pay us back. Therefore, we'll only lend if you can.
Max, I understand the technological and cash flow advantage of buy now, pay later. My question is, what is the limit in use cases? So, you know, an airline ticket can cost you a few $100s or a few $1,000s. I wonder what the point is where a firm says, you know what, we cannot do this, be it, you know, another luxury item or another product category.
So one of the advantages of buy now, pay later to the consumer is that, and in particular with Affirm, again, we evaluate every transaction separately. So at every time when you choose to use Affirm, there is a chance we will tell you, we think you are overextending yourself. It is not financially healthy for you to make this transaction. Please either make a larger down payment, don't transact, find something cheaper. And so you will, or someone will, hear that every minute of the day today and on. We underwrite every single transaction. That's why our credit results have been as strong as they have been. That is part of the design, and that's why buy now, pay later, and Affirm in particular, is better than credit cards.
Max, 24 hours ago, we had Zach Perret, the Plaid CEO, on the show, and he talked about using AI in assessing creditworthiness and lending. I wondered if you could explain to our audience what Affirm is doing with AI in its decisions on buy now, pay later.
I'll nerd out for a couple of seconds because I think it's important. So AI is now this overused umbrella term that means everything to everybody. So there's a couple of different flavors of machine intelligence. Let's call it something neutral. There's machine learning, which has been around for quite some time, and it is statistical learning, all sorts of different terms. But what it means is using statistical analysis and more sophisticated mathematical techniques to assess ability to repay by looking at past trends and data. And we use that and have been using it since inception. That's where a lot of our underwriting advantage comes from. The other more currently excitable part of machine intelligence is generative AI, things like DALL-E and OpenAI and chatbots. We do not use that to assess your credit because we don't think the technology is mature enough, and frankly, it wasn't built for that. We do use it for exciting things like developer productivity, making more data available internally faster through chat interfaces. So there's lots and lots to gain from various flavors of machine intelligence, but each tool is for a different job, and we've been using it since the day we started the company.
You know, Max, you think about technology, you think about what the PayPal mafia has done when it comes to payments online, and you have Elon Musk trying to expand on this everything app. What role is social media going to be playing in payments ultimately, and how long will it take to get there?
I think social media has already emerged as kind of the next shopping format. We're all sort of swiping up on Instagram and TikTok and on, and we see a beautiful thing worn by a beautiful person. Sometimes we want to buy it. I think, again, not to sort of toot my own horn too much, Affirm brings certainty and sense of control and lack of gimmicks and fees into a situation that is sped up. When you're tapping to buy something on your social media environment, you're not thinking very hard about what financial tool you're going to use, but you do want that peace of mind. So picking Affirm will help you, will keep you protected. We are seeing a huge percentage of interaction with computers and with phones in particular shift to these bite-sized social media modalities, and that's just a new normal.
Talk to us about competition. This idea of Apple Pay Later. You are also partnered with large tech companies yourself, like Amazon, but Apple's move into the buy now, pay later space. How much of an impact could that have on you in the future?
You know, for the moment, we're all taking share from credit cards and perhaps even more fundamentally cash. The online e-commerce in the US alone is nearing $1 trillion, if I remember correctly. Offline is 4 times that size. The penetration into that entire thing is sub 1% if you take the totality, and sub 5% if you look at just e-commerce. And so for the moment, most buy now, pay later players are not exactly bumping into each other in the hallways trying to convince that last consumer. There's lots and lots and lots of greenfield before competition matters more than just converting folks from credit cards onto Affirm. And we're making pretty good progress there.
Max, really quick, I do want you to reflect again on your PayPal days and the idea of turning X into a place of transactional e-commerce. Do you see it as a reality?
You know, don't ever put anything past Elon. I think he has proven time and time again that he can achieve crazy things. I do think that the Everything app worked really well in a place and a time in a different country. I don't think US consumer is looking for a version of a 10-cent product.
All right, our thanks to Affirm CEO Max Levchin, alongside, of course, Bloomberg's Sonali Basak. Happy Friday to you both. Right, back here in SF, California's largest utility, PG&E, says it's more prepared than ever for the threat of wildfires. The company spent 5 years modernizing its infrastructure in America's most populous state. It's now turning to AI to predict and control wildfire impact. Take a listen to my exclusive interview with PG&E's CEO, Paddy Poppe.
You know, Ed, I think you'd be quite impressed if you could see the wildfire science that underpins the activation of the technology. The hardware is activated by this software. We have the data system. We've actually divided up our entire service area, 2/3 of the state of California, into 2-kilometer polygons, we call them. And we have readings because of our weather stations, our high-definition cameras that are using artificial intelligence to know the difference between fog and smoke, that are identifying the fuel moisture levels, the humidity, the wind speed, the temperatures, the grass levels, any open maintenance tags in that 2-kilometer block, any tree that's within strike distance of the line in that 2-kilometer block. And we have technology then that we can activate when the conditions are such that a catastrophic wildfire is possible.
So we're talking about spread modeling, essentially, trying to predict the path that a fire would take if it were to occur.
Exactly. So we use the spread modeling with this artificial intelligence engine to then activate our hardware on any given day of the year. We have an operations center that's monitoring conditions 24 hours a day, 7 days a week, 365 days a year. And they monitor those real-time indicators and then use that AI model to predict risk. And then we activate our hardening system. We've put in layers of protection, including our 10,000-mile undergrounding plan, which is sort of old-school construction, but it works. It's very risk mitigating, combined with our technology platform to be prepared every single day to prevent the next catastrophic wildfire.
Do you have to make further investment? I mean, you talked about it being old school, putting the cabling underground, but that's how it's worked in the past, right? Above ground cables, through a number of factors contributing to the cause of a fire. Where else do you have to invest and continue to grow your tech play?
Yeah, well, the tech play in undergrounding is actually quite exciting. We use those models and all of that AI to determine what's the next best mile to bury. We get lots of calls. People want us to bury the lines. So a lot of people would like us to bury their lines.
Strategic about it.
Yes, but we have to use that risk modeling to determine the best miles. And then we're deploying all sorts of new technology to make it way less old school. We actually demoed at an investor event in San Ramon maybe a month or so ago, what we call at-grade undergrounding, utilizing a new steel form with a polymer insert with conduit where we run the conductor and can bury the lines much less deeply, right at surface, and it takes a diamond cutter to cut through this. So there's infrastructure technology that we're deploying, and of course we're deploying all sorts of tools to make sure that every minute we spend doing work, we're doing it in a smarter way.
That was PG&E CEO Paddy Poppy. The main takeaway, wildfire risk from equipment, 94% less likely now than in 2017 because of that tech investment. Check out the full interview on Bloomberg.com and the terminal. Now, coming up, a TSA review finds that using Clear to fast-track security at the airport may leave customers more vulnerable than secure. We'll give you the details next. This is Bloomberg. Time now for what's going viral. Do you remember a scare last year when a man in possession of ammunition slipped through a Clear screening line at Reagan National Airport? Well, that incident was a catalyst to a government probe that uncovered flaws in Clear's practices, at times capturing blurry or obscured images of travellers. Clear responded to Bloomberg in a statement saying, quote, "It is deeply disappointing to us that images were shared with the federal government as part of its review. We share TSA's unwavering commitment to aviation security and have proven ourselves a capable and trusted partner for more than 13 years." One that everyone's talking about on social media. Now, that does it for this edition of Bloomberg Technology. Happy Friday. Have a good weekend. But don't forget, you can recap everything from today's episode in the podcast, wherever you get your podcasts, Apple, Spotify, iHeart, and of course, on the Bloomberg platforms. Big earnings season next week. This is Bloomberg Technology.